Welcome of another great video. We're talking about how to save capital gains tax. It's always a pain. You sell something, you get the capital gain, then you have to deal with the tax. We're trying to see how you minimize the tax burden while maximizing your charitable contributions. Lots to go over here, Kevin. And we're going to start right away with an example just to get right into it here, Kevin. Let's talk about Steve.
Yeah, Steve's buying 50,000 worth of shares of ABC. So that's the first thing that he's done. Now, he's done really well. And what we've come to find out is that Steve's stock now goes up to $100,000. Wow, he's doubled his position. That's fine to have. But all of a sudden, you're going to have to deal with a tax consequence depending on what's gone on. So Steve's gone 50,000 to buy in. It's worth 100,000 now. Now, what does Steve have to deal with? Well, the proceeds, if he sells the 100,000, means that his capital gain is 50. 100 minus 50,000 gives us that $50,000 capital gain. And of course, capital gains are not free to anybody. You are taxed on these, are you not?
Yeah, exactly. Capital gain is tax efficient, but I'll go back here. So you had that 100 grand, you did a phenomenal stock pick, 50 turns into 100,000. He's got that $50,000 capital gain. Half of that is tax free, but the other half is going to be income, Kevin. So you got 25,000 of income that he now has to claim. And then he has to pay the tax on that. And we'll get to the two pieces of the tax and the income, but the income portion of it can be an issue. Let's say you're retired and you got 25,000 of extra income in that 1 year. Well, that might push you over the old age security clawback. Maybe there's some tax credits that you receive that are based on your income. Well, if your income goes up, you might not get those credits. Maybe you're getting the guaranteed income supplement as part of OAS. Well, if your income goes up, you might not get that supplement. So you have the two pieces, not just the tax, but you have the higher income. In this example, 25,000, in addition to having to pay the tax. Now we'll talk about the tax. So you can tell me here about Steve's overall tax bill.
Yeah, so if we assume that Steve's marginal tax rate is 30%, maybe he hasn't moved up, maybe he has, he's got into that. That means that on the 25,000, he has 7,500 worth of taxes that are owed. This is what he has got to pay the government, minus any other deductions or anything you might have. But that is additional tax money that he has to pay. Now, whether he comes up with that through the sale or other places, it is something that has to be looked at. So it's not just simply saying, okay, well, we've got this, we don't have to do it. But there are options that he has for how we can start to eliminate some of that tax as well further down the road.
There is, and we're going to get into a couple of pieces here. We'll look at how you can start to minimize that, what you can do about it. But first, we need to explain how does this actually apply, because it's not for every account. It doesn't apply if you have a TFSA, of course. It doesn't apply if you have an RSP or if you have a RIF. It only applies to what we refer to as non-registered accounts. So I'm going to pull this up here, Kevin. You can see the big list of accounts. You got the table. Effectively, everything on the left, everything in that registered category. Capital gains do not matter. It's only the stuff in the non-registered category, right?
Yeah, anything that has a little mnemonic to it or can be shortened down to those little letters of the alphabet soup probably is a registered account. You don't have to worry about it. If you have to use the word account at the end, chances are you're probably dealing with something that has a tax complement to it. So yeah, so anything that would be considered registered, those ones on the left, anything that's not registered, that is money that you have to pay tax on every year if you've made something on it, whether it's dividends, capital gains, or in this case, or interest, or in this case, as we show the capital gains that have been sold from that. So knowing which account that you have to deal with it from, because again, if this was made inside his RSP, we wouldn't be worrying about any of it because the taxes don't apply there, or do they apply to the TFSA or any of those other ones? So it's strictly that non-registered scenario, the money that you've got listed there, that does have a tax consequence to it.
Yeah, and we deal with questions like this all the time, whether it's on the capital gains, whether it's on drawing down RSPs or RIFs, or how to do that was part of a financial plan. So if you have a question on anything in that area, let us know. chatwithclintonkevin.com. We always appreciate the questions. We always appreciate the viewer engagement. So go to that part of the website, fill in the form, comes right to us. You get a personalized question, you'll get a personalized response. I think that's got to be part of our new motto here. So fill in the form, chatwithclintonkevin.com. We'd love to hear from you. Let's get into what you can do about it. We kind of give you the scenario, what happened with Steve here, the income portion of it, plus the tax portion of it. What he can do about it has a couple of pieces. The first off, Kevin, is there are some credits that you can claim if you've made a donation.
Yeah, basically you get to claim a little bit here from the government because you've made a donation. Now, if you're making donations there, they're going to give you a certain portion of that donation as a tax credit. So you don't have to worry about paying for it down the road. And depending on the province you'll get a provincial tax credit, but you'll also get a federal tax credit. Now, the federal tax credit applies the same to every province, but each province has a different scenario for how they set up, whether you get paid on a small amount of money, what you get paid on a larger amount of money. And these would be the numbers that we're looking at, aren't they?
Yeah, and this is showing the combined factors here. It's a lot of going on, lots of little numbers here. We'll quickly walk through it. You can see the federal level here. This is the 2023 level, tax donation levels. Federal government on the first $200, they'll give you 15%. Any amount over $200, they give you 29%. And then each province here, they're all listed, have their own numbers. Most provinces,
Yep.
I think with the exception of Alberta, on the first 200, they give you a lower credit, and a donation above $200, they give you a larger credit. And it's really this last column here that we're looking at, $1,000. Well, in Alberta, that'd be a combined $550 of credit that you'd get back. That's a nice little tax savings. You donate $1,000 to save $550 of tax. Now that's the federal and provincial combined. You can see how it varies depending on where you live. Kind of $350, $360 on the low end, $550 on the high end there for the credits. But that's really what we're getting at as a potential solution. How can you minimize that bill while maximizing the impact of charities? It is going to be those donation credits. And then there's special rules that we have to talk about when you deal with this, because that relates very much to this tax situation. It's the special rules around donating in kind.
Yeah, the donation in kind is a really interesting one, because normally what would happen, we've seen beforehand how that goes on with, if you cash it and sell it, you're going to pay this amount and everything else. But if you take the donation, Steve bought his 50,000, it's worth 100. If he takes the shares as is, if he does not sell them, but strictly donates those ABC shares to a registered charity, he's going to get a donation receipt for that entire $100,000. So there is absolutely no capital gain that he has to worry about at all, because he's not claiming a capital gain. He gave a donation for the entire amount. So with no capital gain, the donation in kind, he's now getting a donation receipt for $100,000. And that's going to be huge playing against his taxes, because all of a sudden we've eliminated that capital gain tax, haven't we?
Yeah, and that's the whole idea. Remember earlier we mentioned kind of two issues here. Is the income. You'd have to claim a big income. So if you had $50,000 capital gain, $25,000 goes on his income, which could hurt all your income tested benefits. Plus he actually has to pay the tax. In this case, he doesn't have to pay the tax. And then plus that income disappears, the whole capital gain disappears. And also the benefit, when you look at the charity gets the full $100,000. They don't have to pay the capital gains tax. They get the full value they can use for their charitable efforts. So it's kind of a win-win there. And then you do get the donation, so you do get the full tax receipts. So depending on where you live, remember that big chart with all the busy numbers, depends what province you live in, you're going to get, call it $36,000 to $55,000 back. So you got a $100,000 donation receipt. So you got rid of the income, you got rid of the tax, plus you get some money back. So you're going to actually get a refund of $36,000 to $55,000. Now, folks might be sitting there doing a bit of math, Kevin, and going, well, scenario one, I sold $100,000 worth of stock. I had to pay, claim some income plus pay $7,500, but I get in my pocket $92,500 at the end of the day. Scenario two, I donated this to charity. I have no income. I don't have to deal with the tax. In fact, I get a nice tax receipt, but I'm only getting, 36 to 55 in my pocket, not 92. That's a bit of a difference there. Well, it has to do with really your overall goals of the funds.
Right. Yeah, I mean, the biggest factor is, were you planning to donate in the first place? I mean, as we've said beforehand, you don't want to deal with investment strictly for the tax purposes. You want to deal with it for an overall scenario. But if you were planning to donate as part of what you're going to go doing forward with your investments and things along those lines, this is the perfect article to do with it. Don't bother cashing it and then giving the money that way. You're better off giving the shares as is, because again, as we've shown, you eliminate having to pay anything for you. You've got that sort of charity donation amount that comes back, and the charity gets the entire amount and they don't have to worry about the taxes. So the planning on donating is really something that goes on. And of course, if we're planning on donating, why would we plan on donating? What do we have, Clint?
It's part of the Becker Orr motto. It's having a plan. The whole concept here is, if this is part of your larger estate plan to help out a charity or a cause you believe in, well, this is a very tax efficient way you could do that. So you'd be saving yourself some tax. The charity gets the benefit. It would be kind of a win-win scenario. You wouldn't want to sell the stock, pay all the tax, and then turn around and give the cash to the charity. Now you're just paying more tax and giving less to the charity. This is kind of the best of both worlds, minimizing the capital gains to you, plus maximizing the benefit to the charity. If you like this video, we have other videos on this concept, specifically one on donor advised funds that's floating on the screen right now. Click on that one. We'll see you again very soon.